Welcome to the deep dive. Today we're providing you with, let's call it the ultimate shortcut to understanding corporate finance.
Yeah, we've boiled down the essential stack of financial formulas, the real language of business performance.
We're looking at how to assess a company's health, its efficiency, and, its market valuation.
And if we're doing that, we absolutely have to start at the foundation, the basic balance sheet equation. It's the bedrock.
Total assets, total liabilities, plus shareholders' equity. Okay, let's unpack that. Why is this the critical starting point?
Because it demands balance. It's double entry accounting in its purest form. Assets are what the company has or uses: buildings, cash, inventory.
Right, stuff it owns.
Exactly. And the other side of the equation tells you where the money came from to get that stuff. Did you borrow it? That's liabilities or debt. Or did the owners chip in? That's the shareholders' equity or funds.
So it's this constant snapshot, making sure every dollar, every asset is accounted for.
Couldn't have said it better. It guarantees things are in balance.
Okay, so that's the static picture. Now let's get dynamic. How do we measure immediate financial health?
Yeah.
Liquidity. People talk current ratio, but analysts often jump to the quick ratio, the acid test.
The acid test. It's called that because it's deliberately harsher, more stringent than the current ratio.
How so?
Well, it takes your current assets, the short-term stuff, but then it strips out inventory, stock.
Why exclude inventory? Seems important.
It is important, but it might not be liquid. You might not be able to sell it quickly. Maybe it's gone bad, or it's last season's fashion. The quick ratio asks, can you pay your immediate bills without relying on selling that inventory? Just using cash, receivables.
Things that are closer to cash. Okay, so it's a more conservative view of solvency, useful if inventory turnover is slow.
Precisely. Traditionally, you'd want to see a ratio of 1.1, meaning $1 of easily accessible assets for every dollar of short-term debt.
The quick point here, it still includes accounts receivable, right? What if those customers just don't pay up?
That's the limitation. It assumes those receivables are collectible and reasonably quickly. So yeah, a high quick ratio could maybe mask problems if collections are actually weak.
Which leads us perfectly into activity ratios. How efficiently is management turning things like sales into actual cash? Let's talk average collection period.
Right. This one's pretty straightforward. It tells you, on average, how many days it takes the company to get paid after making a sale on credit.
Calculated how? Accounts receivable divided by average daily credit sales.
You got it. And its application is direct. Say the company tells customers, pay us in 30 days. That's their policy.
Okay.
But then you calculate this ratio and it comes out to, say, 60 days.
Whoa, so they're waiting twice as long as they intended.
Exactly. That means the collections department isn't efficient, or maybe their credit policy is too loose. Either way, it's tying up cash. A big drag on working capital.
Makes sense. Okay, shifting gears again. Let's look at risk. Financial leverage. How much debt is the company using? Interest coverage ratio or times interest earned?
Yeah, TIE. This is a huge one, especially for lenders. Bondholders love this ratio.
Because it shows if the company can actually afford its debt payments. It's EBIT earnings before interest and taxes divided by the total interest expense.
Correct. It's a margin of safety. If the ratio is, say, 5x, it means the company's operating profit is 5 times greater than its interest bill. Profits could fall quite a bit, and they'd still be able to make those interest payments.
So a higher ratio means lower risk for the people who lent the money.
Absolutely. In fact, lenders often write it into loan agreements, covenants they call them. They might say your interest coverage ratio must stay above 3x or you're in technical default. It's that critical.
Okay, got it. Now let's look at it from the owner's side. Profitability. The big one here is return on equity, ROE.
Right, ROE. This is kind of the shareholder's main report card. It measures the rate of return generated on the money the equity investors themselves have put into the business. Net profit after tax divided by shareholders' equity or fund.
So it tells shareholders how effectively their capital is being used to generate profits.
That's the core idea. But just looking at the final ROE number, well, it doesn't tell the whole story, does it?
No, because how they achieve that ROE matters. Is it high profit margins, super efficiency, or just lots of debt?
Exactly. That's where things like the DuPont analysis come in handy, breaking ROE down into its components: profit margin, asset turnover, and leverage. It shows the strategy behind the number.
Which brings us finally to the market's view, investor sentiment, the famous price-earnings ratio, PE. Everyone quotes it.
Everyone quotes it. Market price per share divided by earnings per share, or EPS.
What does it really tell us, though, beyond just a number?
It's fundamentally about investor confidence and expectations. It shows how much the market is willing to pay today for every dollar the company is currently earning.
So a really high PE, like 30x or 40x, doesn't automatically mean the stock is expensive.
Not necessarily. It often means investors expect those earnings to grow significantly in the future. They're paying a premium for anticipated growth. It's
Right.
very forward-looking.
Right. It's about future prospects baked into today's price. So these ratios, taken together, they're like different lenses, aren't they? From internal operations to market valuation.
Powerful lenses, yes. They let you see beyond just the surface numbers, understand the strategies, the risks, the expectations.
So to wrap up, let's leave our listeners with something to chew on, a bit of a strategic puzzle.
Okay, I like it. Here's one. Tying back to that ROE breakdown, imagine a company. It has a really low net profit margin, NPM, so not making much profit on each dollar of sales, but it has an incredibly high total asset turnover, TAT, meaning it's unbelievably efficient at using its assets to generate those sales. Think like a high-volume, low-margin retailer.
Again, low margin, high speed. What's the question?
The question is, which should investors prioritize more, that low-quality profit margin or that amazing asset efficiency? And why does that difference in strategy really matter for sustainable long-term growth? Something to think about next time you compare companies.